Welcome, viewers. Today we're speaking with Jeff Rombough. My name is John Lindsay, and Jeff is an expert at investing in real estate, especially in the Calgary market. And we're going to have a series of questions and answers that will help you get an idea why this is such a exciting and worthwhile investment. So, Jeff, you started out over 20 years ago, and today you've got well over 20 properties. You've made your mistakes along the way. One of the questions that I have for you is that, which doesn't make sense, is that instead of selling the properties, in your case, what you do is you get them and hang on to them. Now you have the one that you sold along the way because of the situation, but you hang on to them a long time, and in fact, you still own the very first property you ever bought. So why do you manage your business that way?
Well, thanks, John. Yeah, I started investing back in 1992 when I bought my first property. And I bought that property for $125,000. I still have it today, and it's worth about $600,000. So I guess where else can you get that kind of rate of return of investing a 10% down payment of $12,000? And today it's worth just under $600,000. So for me, I found instead of a lot of people like to buy properties, renovate, sometimes they buy and flip or buy and sell. What I find for the best rate of return you're looking for is you want to buy a property and hold on to it for as long as you can. The second thing I found in terms of the strategy is if you look at it around the 8 to 10 year mark, you've paid down the principal of your mortgage, the value of your property has gone up over time. And around that 8 to 10 year time frame, there's a pretty big spread between the value and the value of your mortgage. What I found works for me is you can take that mortgage and get a new mortgage based on the value of the property and take that money tax-free and do whatever you want to do with it. You can buy a second property, you can buy other investments, you can pay down the mortgage on your existing home, you can go buy a car, you can do whatever you want. But that's how I kind of built my real estate portfolio. As I bought that first property, I remortgaged it around 5 to 6 years after I had it, took the money and then bought my second one and just kind of grew it from there. Like you said, today I own just over 20 properties, a couple in the U.S., mostly here in Calgary, and it's done very well for me over the years.
Okay, my next question is it relates to how do you make sure that they're consistent earners? I mean, real estate is known as a consistent appreciating asset with consistent earnings that come in. So what have you done over the years to make sure that it's always consistent? Because I've looked at your financials and really you are Mr. Consistent.
Yeah, so I guess the way that I learned how to do that just over the years by making mistakes and learning from them. What I try to do now is I try to find a good property in a good location. Might be close to schools, close to transit, close to shopping. If you get a good property that you might live in or that's renovated, it's very desirable, you find those easy to rent. Just to give you a bit of an example, the vacancy rate in Calgary is around 7%, and I have 37 suites in Calgary, and my vacancy rate is 0%. So if you're buying properties that you might want to live in that are desirable, you're going to find they're very easy to rent out.
One of the questions I have is, and it relates is to this is the finance part of this. So with Mr. and Mrs. Average Homeowner in their situation, what they're trying to do is reduce the mortgage as quickly as possible. But in your case, you have a steady deceleration of the mortgage value over time. But if possible, you will increase the amount of the mortgage,
right,
which is counterintuitive to most people with mortgages. So why do you do that that way?
I guess the way you look at it is it's running as a business. So when you're paying down the mortgage, you're paying less interest, less interest to write off on your taxes, which means you're paying more tax. So what you want to do in this case is you want to try to maximize your write-offs by increasing that mortgage. Like I was saying, if you take a mortgage, refinance it over an 8 to 10 year time frame at that point, then you'll be able to take that money and do whatever you want, but your expenses are higher. So you're not paying the same amount of tax on it. If it's your principal residence, you don't get any tax write-offs for that. So again, you want to pay that off so you're not paying interest on a mortgage or a debt that you would have. So for me, for my business, I like to keep my expenses high, so I pay less tax at the end of the year.
One of the things about real estate is it's been said that with real estate for the long term, either you're buying or you're paying. Could you explain a little more about what that statement is and the truth of that, that either you're buying more real estate or you're paying more taxes? What goes on there?
Right. I guess it's kind of similar to the last point that we talked about. What you want to do is you want to try to have more expenses. So if you keep a property and just let the mortgage be paid down, in year one you pay down 10,000, year two 10,000. So by the time you're at year 8, you've paid down $80,000 of that mortgage. So you're paying less interest on that. You're not the principal is not there; it's been reduced over time. So you're paying less mortgage interest. So what I try to do, like I was mentioning, is I try to increase the mortgage amount, and so I've been able to take out a tax-free kind of withdrawal from the value of the property to get the mortgage back up to it was initially or even higher, because the value of the property is now higher. You're paying tax on your mortgage interest, but you can take that money and use it for whatever you want to do. So again, you want to try to increase your write-offs by having more interest payments and getting that tax-free money to go do whatever you want to do with.
Uh-huh. Well, here's another question. In Alberta, because of the changes of the oil market over the last few years, the economy's been having a tough road to hoe. So what have you done in your properties to make sure that you always have the consistent revenue? What kinds of things so you don't have vacancy issues and you have the right people paying on a regular basis?
Right. So I guess it goes back to buying the right property in the right location. I'll renovate them, I'll paint them, I'll do small things for my clients. I call them clients instead of just tenants. I look at them as their clients. Run it as a business, take care of your clients, they're going to want to stay there. I have some tenants that have been there for 10 years, some have been there for 13 years. And they're paying down my mortgage and allowed me to be successful in my investment. So if you treat it more as a business, a place you do want to live, in a good location that's well maintained and you're easy to deal with and take care of problems as they arise, you're going to find people want to stay and they're happy to be in your property. So by doing those few things, I've had 0 vacancies, I've had long-term tenants, and it's been very successful for me. And for them, it's been a win-win for them as well.
Do you search for properties that are ideal from a tenant's point of view?
I try to. When I'm looking for properties for myself or for my investors, the one question I want to ask is, would I want to live in this area? Is it a quiet street? Is it close to shopping? Is it close to schools? And what's the reason I would choose this over another property when I'm looking to rent a property? And by using that kind of mentality, and like I said, maintaining them and keeping them at or above the market standard in the area, you're going to find they're easy to rent. A lot of times I get calls from previous tenants, seeing if I have vacancies that have come up, or they're referring their friends or families that are looking for properties. I get calls all the time from people that want to rent properties because they know that I have good properties and good locations that people want to be in.
And in your situation, one of the things that's developed is that you're attracting people who want to become partners with you in the real estate that you own. Right. What are the factors that go into that? Why do they find your efforts attractive and for the long term?
It's what I've done for some people that I know, and friends and some family that are kind of nervous about getting into real estate. You always hear the one bad story that everybody talks about. But for me, what I'll do for some people is I'll show them what I've done. I've done it for 25 years. I know what properties to buy. I know the process to set up. I know how to make it as risk-free as possible. So if somebody's interested, I'll partner with them. We'll get together, agree on terms and conditions and how it's going to be, get a first property, help them manage it or manage it for them. And I find, after we've done that for 2 or 3 years, people are loving it. They're understanding what the risks aren't what everybody thinks they are, because they're buying the right properties in the right locations, and they want to get their second and third property. So, I've helped people get into it, get started, and once they see exactly what it is and understand what they want to do and where they want to be, it's been very successful for us.
Okay, here's another question about mortgage rules. The federal government in 2018 put in new rules, and essentially, to sum it up, if your mortgage payment was X, they do this artificial gross up that the mortgage lender has to put in place, where they indicate that your payment is not really what it really is. It's actually this higher rate, and that has been knocking some buyers out of the market because it means they just can't afford what they particularly wanted in the first place.
Right.
So how has that affected your situation for investing, and what's it going to look like going into the future?
Well, for me, I try to stagger my mortgage due dates so not all coming due at the same time. So I have some 5 year, some 4 year, some 3 year. I kind of manage the risk of the increased interest rates that way. What you're talking about is buying a property. So when you go to buy a property and qualify for a mortgage, the government's making you qualify at a 5 year rate. You're not going to pay that rate. That's just the rate they want you to qualify at. So they want to make sure that if the rates go up to a 5.2%, people are still able to afford their monthly mortgage payments and there won't be any foreclosures at that rate. So the only time that really comes into play is when you're looking to buy a property. And as you mentioned, the amount that you can afford in terms of a value of a mortgage has now been decreased because they're making qualify at the higher rate. So you've seen in the market is some of the, like you mentioned, some of the people can't afford the value of home that they were looking for, and some people are just waiting. It hasn't really affected me because my business is existing properties and I'm starting my mortgage like I mentioned. But for people that are looking to get into their very first property, I've talked to some clients about buying a property with a basement suite in the basement. So you can use that income to qualify for the mortgage. That'll help you get into a higher value home today rather than waiting to save more of a down payment or increase your earnings to qualify for that higher mortgage.
Okay, understood. So to sum up, what is it that you like about real estate over the long term as an attractive investment that just keeps you engaged?
For me, the biggest thing is I know it's a good to great rate of return. You make 10 to 14%, which is what we did in 2017 on our properties in terms of cash flow on your investment. There's also a huge upside in terms of the increase in value. Got my first property for $125 in 1992. It's worth $600,000 today in 2019. So you're not going to see that rate of return anywhere else. It's a hard asset that I can drive by. I can feel good about being able to find properties for people to live in long term. So it's a win for me in terms of being able to have a good investment. It's a win for the tenants and being able to have a good place to live and being able to rent from a good landlord who provides a good quality, safe place to be. So I find, it's just a win-win property. And when I drive by, I can feel proud and happy that I can see my investment that I can control. And I know exactly what the numbers will be. So being able to control it, being able to enjoy it and have a great rate of return is pretty much a no-brainer for me.
Well, Jeff, thank you very, very much for your comments today. You've got a great story. And thank you, viewers, for tuning in. In a moment, you'll be able to see a slide with Jeff's contact details for future reference.